Hey Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, I'm actually going to go over Bollinger Band's strategy. Guys, as you know, I use the Bollinger Band midline in a lot of my trades, and what the midline is of the Bollinger Bands is essentially it's the 20 simple moving average, okay? So it's one of these moving averages that price action tends to check back to fairly regularly, okay? Probably the most regularly checked back one is the 9 EMA, but in my case, I use the 21 EMA when I'm using my EMAs, and so I use the 9 and the 21 to find squeezes. But on the Bollinger Bands, just the way that Mr. Bollinger set them up, he's using the 20 simple moving average, and it behaves very, very similarly to the 21 EMA, which you guys know I use on my EMAs. So again, it's just a very reliable to have as a midline on your chart because price comes back to that midline quite often. Now, what are these blue bands that I have around the midline? Those are the Bollinger Bands themselves, okay? So Mr. Bollinger, and yeah, that's his name, he actually designed this to have two standard deviations of price movement within the band at any particular time, both to the upside and to the downside, because that's typically where you find price getting to a point where traders like to take profit. Now, he originally designed this for stocks way back before there was the internet. And the man is still alive today, guys. So, he's still giving commentary about his Bollinger Bands. But it turns out that they ended up working out for everything, including crypto, including all of this data centric trading that we have today. But in his day, it was an innovation because, of course, it just calculated those deviations for you, and traders just took their profits around those areas. Now, you can imagine something similar, which would be maybe some type of Fibonacci numbers or something that people like to take profit at. But in this case, Bollinger Bands has that philosophy of profit taking built into it. But it also has something else, which is where if you get embedded along the edge of the Bollinger Band, then it suggests that you could potentially be on a nice bull run, okay, if you're to the upside here. And likewise, if you get embedded to the Bollinger Band's standard deviation on the bottom, then you're probably in a bit of a bear run, okay, guys? So this is what we're looking for. We're looking for, are we flipping the middle of the chart? Okay, are we flipping that Bollinger Band midline, and are we getting embedded at the top of those two standard deviations? And you can see what happened here, right? Price was just kind of meandering around the line. It flipped up here. It ended up getting embedded on the top of the Bollinger Band deviation line, and boom, like that was just a massive bull run. Same thing here, just kind of meandering around, got embedded on top, then just went for its run. Same thing down here to the downside, and again, same thing here to the downside. Okay, so the first thing that I just want to introduce you to is, are we crossing the midline? Right? Is momentum shifting? And let's just say that you didn't capture a move, but you wanted to capture the next move. So here we have price coming down, and you can see it's embedded below the Bollinger Band midline, right, guys? That's what I tell you. Like, you're looking for that embeddedness, and then suddenly it's just like tapping the middle area. Then it taps it again. It taps it a couple times. The Bollinger Bands are kind of squeezing in together, just kind of narrowly entering this area. Well, as it's just crawling on that midline, eventually it starts to test the other side of it. And that's what I call getting embedded. Okay, guys, it's getting embedded on the other side of the Bollinger Band midline. And that suggests that if there's any bullishness in the market, that it could potentially reach those 2 standard deviations to the upside, and then even have the chance to crawl up it. So we're always looking for that move. That's why I'm always talking about the Bollinger Band midline, because we're always looking for the moment that we flip it where we have a momentum change, and that momentum change gets embedded and then just starts to crawl up, and then we're going to try to capture this move. This is the move that we're going for. We're not going for those little flips, okay? That's what these scalpers are doing. That's what these guys who are trading on the 5-minute are doing. Nothing wrong with that. And a 5-minute position can end up in a multi-month long position. I've got 4 years of Bitcoin on the chart right here, okay? But if you're able to identify this sort of structure, I've got the 3-day chart up right now. If you're able to identify this type of structure on the 3-day, then you can go for some pretty epic trades, guys. Okay, pretty epic trades here. And so far I think the Alpha Fam has been capturing these moves. So congratulations, guys. You guys are just killing it. But I did want to just give a little bit more detail to this strategy. Okay. Now, for me, I don't really use the outer Bollinger Bands. I just use the midline primarily because I'm an EMAs trader, and that is a simple moving average that I can just kind of eyeball where the deviations are going to be, just because it's already burned in my brain. But if you're starting out, you probably want to leave those Bollinger Bands out there so that you can see, yeah, we're embedded above it, and now we're actually embedded on the deviation itself. And since we didn't really come back to the Bollinger Band midline, there's a good chance that if we have a change of, even if we have a pullback, if we have a change of momentum back to the upside, that it's just going to continue to be embedded on that Bollinger Band deviation line up there, which suggests that the market's going to continue. So again, as long as we're above that 20 simple moving average, we tend to be in a bull market on these higher time frames. Here I have the 3-day, and if we're underneath it, then we tend to be in kind of a bear market. Now, obviously, there's going to be weird little fake outs and shakeouts, but the thing is that you're usually going to get some type of indication when you cross that Bollinger Band midline, whether or not the unthinkable could happen and you just lose all of your position there, which means that the Bollinger Band midline is an excellent place for entries and an excellent place for exits. Enter, exit, right? Enter, maybe exit here, then you re-entered, and then you exited here. Overall, you caught this move, right? You caught this move, just if you were going long. If you were going short, then you also caught that move, okay? Now, you're not going to get 100% of the profits, but all in all, you're going to be doing pretty good. So just using a Bollinger Band's midline strategy, you're already ahead of the majority of the market who are just using their gut instinct. Now, you can additionally apply some logic, because sometimes there's only like single moves, right? They're not all going to be bull runs. Sometimes they're just single moves. So what would happen if you want to use the Bollinger Band's 2 standards deviation is that you would look, when did I bump my head on that standard 2 standards deviation? Then maybe I should take some profit. Okay. And if we continue to go up and we bump up our heads on the standard deviation as it is expanding, then we take some additional profit. Okay, and even if we bump our heads on that thing, maybe we end up shorting it. So you can even take a reversal play off of the top. Now, this isn't going to be as reliable as using the mid line strategy, because the midline does show a shift in momentum. But you can get an idea of where you should start taking your profits and where you should start preparing for a reversal. So in this case, we would have been embedded below the Bollinger Bands. We got above it. That was kind of a long signal. We take the long until the Bollinger Band's 2 deviations line. We take some profit. Yeah, it continues to go. We take the rest of our profit because we're not going to be too greedy. We start positioning ourselves to short when we perhaps start seeing some deviations in the market, bearish deviations, and then we take the short. We can take our first profit at the midline once again, just in case it bounces off, or we can wait till it breaks through and then take it at the next deviation to the downside. And so this is how you guys can use a reversal strategy for your Bollinger Bands, just using them as kind of a bouncing point, right? Where, crossing the midline, maybe you get into a position, hitting the 2 standards deviations, you take your profit, and perhaps even do a reversal play, and then you take your profit again at the next midline. Again, that gives you another signal if you cross it to go in that direction, and then you take your profit again at the next standard 2 deviations. Since this Bollinger Band is always printing on 2 sides, right? It's always printing the bands on 2 sides, then you automatically have a target just right there on your chart for you to kind of eyeball where you should be taking your profit at. And that's what a lot of people like about Bollinger Bands, right? So you can kind of see where, you can just kind of eyeball where you should be taking that profit. You can see the bottom of the band was right here. Maybe you should take that profit if you were shorting from here, right? You should maybe take your profit right there. And if you were longing from here, as that Bollinger Band's outer line printed, then you should probably take your profit right there, right? Now, that's again not going to be very precise at all. So, how do we make this a little bit more precise? Well, the trick is you want to use at least one other indicator with it, okay? Now, my favorite is the RSI, and then I also use the slow stochastic quite heavily. Now, the slow stochastic is different from the Stoke RSI, which I use to determine volatility. But in case of the Bollinger Bands, I recommend using the slow stochastic. Now, there's something that we need to understand about the Bollinger Bands before we move on to using it with other indicators. It's called the Bollinger Band squeeze. Anytime you see that the Bollinger Bands get really narrow after a period where they were quite big, then you can imagine that a big move is going to come up, okay? So this is essentially like all this price action is being pushed into one little spot, and then it's either going to shoot up or it's going to shoot down just because of the nature of volatility, okay? As volatility gets low, randomness comes into the market, because obviously if price was too predictable, then everyone would go for the same price, and markets can't have that, because if everyone's a winner in the market, then there's no place for the profit to come from. So what happens is that spontaneously volatility appears in the market, which then just pops price in one or the other direction after a period of low volatility. That's why we're always looking at volatility. We're looking for volatility to get low on the Bollinger Bands so that we can perhaps capture those big moves that come after it, okay? Now, it's not always going to be to the upside. Sometimes it can be to the downside. Volatility is direction neutral. The Bollinger Bands are direction neutral. That's why you want to find out, are you embedded above it or are you embedded below it? It can still shoot you down even if you're embedded above it, but at least you're going to get a heads up at that midline. That's why you want that midline on your chart, guys, because if volatility randomly shoots you to the downside, even though you were above it, you're going to get that heads up at the midline. I just don't want to don't want anyone to miss that point, because you have to trust the tools that you're using here. So let's go ahead and just mark out some places where we see that the Bollinger Bands were kind of fat and then they got skinny. Okay, well, it happened somewhere around here. Then let's see, it happened. We can call this like kind of a fat area, and then it got like kind of skinny right there. And then same thing somewhere, somewhere around here. And I guess we could consider this one also. Yeah, we could consider this right here. There's a little bit of a squeeze. Here's a little bit of a squeeze. Here's a squeeze. This could be considered, but don't really consider it. This one's a squeeze. Here's a squeeze. Here's a squeeze. Here's a squeeze. That one, I mean, we can consider this whole little area to be one. And then this whole area right here could be one, but we really see one right there where this was just really fat and then it became really skinny right here. And so, yeah, let's just leave it at that. I think that's plenty to work with. And let's just go ahead and, well, let's just put one more on here right here. Okay, now remember, these squeeze points are direction neutral. We have no idea which direction that they're going to go. So the first thing that we want to do is throw up our RSI, okay, and then also throw up our slow stochastic, okay. It's a slow stoch, STOCH, okay. And what we're going to do is find out, is the stochastic pointing up or is it pointing down? Well, in this case, it just flipped from positive to negative. So right there, that's giving us the heads up. And so I'm going to change this one to red because that one was showing negative on the slow stochastic while we had this really tiny area on the Bollinger Band's width right there. And then what else do we see? We also see that the RSI is starting to turn down. It's crossed its EMA to the downside and it's pointing down. And again, this is before all of this price action. So we can see literally right here, and again, this is on the 3-day chart, we can see literally right here, what potential, what directional bias the random volatility off of the Bollinger Bands is likely to give us. And what we can see is that this one suggested down, okay, and this one also suggested down. And then we can enter on that candle because that was a really huge area over here that just became really skinny. We would expect it to expand somewhere around its kind of a normal width before that squeeze. And what ended up happening, we would have gotten a 48% play to the downside. So you could have taken a short and gotten 48% off of that. Now, what happened? This area was really fat. You can see somewhere around here, it started to get skinny again. It started to round up. Started to round down, round up over here, and so it's starting to get skinny again. So you probably would have taken your profit somewhere where this, this bulbous area started to turn down, or at least where this bulbous area over here started to turn up. I usually take the first signal. I don't wait for the, there's always like an oval shape, right? So it's not a perfect circle, and so one side is going to start turning before the other. I always take it when the first side starts rounding. Okay, it's just a good kind of rule of thumb. And so where we would have taken our profit was probably right about here when we started to see that the Bollinger Bands started to turn back down after coming from this narrow point, expanding, and then turning back down. Probably just would have taken some profit there. And look at that. Look at that. It's right at the bottom of this move. And what else can you see? The RSI started to turn up. So this would have been the natural profit point. And also you can see here that the slow stoch started to turn up. Now you see why you can't just go by the slow stoch? Okay, and you also can't just go by the RSI, but you also can't just go by the Bollinger Bands because you have no idea if this thing's going to come back or what, right? But using all three of these together, you just had a system that allowed you to essentially take, even if we ignore this candle, you got basically a 40% move to the downside. Now, if you were on 20x leverage, obviously that would be quite a huge move, right, guys? So, yeah, I mean, 800% gains. All right. So, Yeah, don't dismiss the strategy that I'm sharing with you here. It obviously can make you a lot of money. Now, over here we can see, okay, we're starting to narrow, the Bollinger Bands are starting to narrow, they're starting to narrow, they're starting to narrow. They're starting to get wide again right here. So maybe this is kind of an area for us to look at. Over here, we can see that our slow stoke has a positive bias. Our RSI has a positive bias. So we're just going to take a chance that if we get embedded, okay, on top of these Bollinger Bands, which we did, we got embedded on top of it, that we're going to take a long off of that, assuming that we don't end up breaking down. And so, again, like the key point is we broke up above the Bollinger Bands, okay, our momentum shifted direction. We broke up above the midline. The Bollinger Bands are concentrating in an area where we broke up at, and then the RSI and the slow stoke was saying, go ahead and take a chance while you're embedded up there. Now, obviously, the slow stoke is, it's not going to be perfect by itself, and the RSI is also going to pull back. And the key point is, are we still embedded above the midline? Yes, we're still embedded above the midline. So we're just going to hold that trade sideways. We're just going to go sideways here. We don't know how long volatility could be low. But since the Bollinger Band midline is still pushing its way up, it's just kind of slowly rounding up. Nothing to worry about there. We haven't broken down from it. And if we break down from it, then we're going to have our stop loss underneath that Bollinger Band midline. But in this case, what happened is that just randomly, I told you the volatility is random. Randomly, we started having that point of expansion. And you can see that the stoke was still pointed to the upside. RSI still pointed to the upside. And more importantly here, you can see that above the 70% mark on the slow stochastic and also above this 60% area on the RSI, we got embedded on the RSI and we got embedded on the slow stochastic. What does that imply? That we are just in these bullish control zones on these two indicators? Well, that suggests that there could be bullish continuation. So as long as we hold the bullish control zone of the RSI above 60, and as long as we hold the bullish control zone on the slow stochastic above 70, then I'm going to say just stay in this trade. That's according to my strategy. And here you see that we stayed embedded on the 2 standards deviation of that Bollinger Bands outer line. And the only time that we ended up really breaking down was when the slow stochastic broke under 70 and also the RSI broke under 60. And then that suggested to us that it could be time to take your profit. Okay, and so if you had taken your profit there and you had entered over here when you got embedded, then even giving a little bit of a give and take, and let's just say a late exit, you got 184% move out of that. Again, just trading on the 3-day, okay? You're not feeling rushed. You're not feeling stressed. You're trading on the 3-day, okay? You're not trading on the 5-minute or 15-minute, right? Just because you followed these simple rules, guys. And so just going to clean up the chart a little bit there. And let's go ahead and go to another example. So again, we got that push. The band started narrowing. Okay, so we're probably going to take some extra profit there. If we haven't yet, they started to narrow and narrow. We're going to take our profit. And here we go. We're starting to get, just kind of testing that midline. Looks like we're getting embedded. See, we were previously embedded above it. And then we flipped it and we got embedded below it. And we also had it narrowing here. So that suggests there may be an entry here. And according to our RSI, we're headed to the down direction. According to our slow stochastic, we're headed to the down direction. So we're going to go ahead and give that just a red tint. That's just our bias. We're embedded below the midline. we're on a downtrend on the slow stochastic, and we're on a downtrend from the RSI. And so we're just going to give ourselves a little bit of a bias to the downside here. You can see we broke the midline on the RSI. We're starting to test the bearish control zone on the stochastic. And what can you see? We got embedded in the bearish control zone on the slow stochastic. We were just kind of skirting the bearish control zone on the RSI. And during that time, we ended up skirting the 2 standards deviation on the Bollinger Bands as we were embedded underneath the midline. And so we got a nice trade. To the downside, as you can see, we popped back up. We crossed the RSI EMA. We broke out of the bearish control zone on the stochastic, and look, we just got a nice pop. So we would have taken our profit right about there, which would have been right here on the stochastic, or pardon me, on the RSI. And just about the same spot was a flip on the slow stochastic, but really it would have, you could have had some loss there. But the point is that once you started to push away, you started to break above this candle, maybe you would have taken your profit, or you could have flipped to a smaller time frame. So let's drop down to the daily, because we don't have to be stubborn about these time frames, okay? So we go down to a daily. And on the daily, you can see, yeah, so we did end up breaking up right here. We did end up turning up right here. So our short should have been over. You can see on the daily, we broke out of that bearish control zone to the upside while we were doing the same thing on the RSI. And that would have just given you a signal to get out. Now, this one would have been a play that didn't really give you the same type of gains as the other ones, but you wouldn't have been worse for the wear. You would have been in profit when you took your money off the table. And, if you had taken the strategy of taking some profit off the table when you hit the 2 standards deviation for the first time, then you would have also been able to pocket that money, even if you continued to short with the rest of your trade. But guys, we're back on the 3-day. You can basically see these small trades for the same type of a deal there. And again, you can see when we're embedded on the slow stochastic, try to say that 5 times fast, and then also on the RSI, and you're above the Bollinger Band's midline, then you can go for a nice long there, right? When you're embedded on the downside, and you're also embedded on the, again, the bearish control zone on the RSI and the stochastic, and you're below the midline on the Bollinger Bands, then you can potentially take a short. And so this was, of course, the virus era. But even before that happened, the Stoke was already coming down, the RSI was already coming down, and so this was just a normal trade to take, and you could have captured that whole move just based upon these principles. And then on the recovery wasn't that easy to catch. We did see that we flipped the midline here, so above the midline, getting into the bullish control zone, in the bullish control zone actually over here, then again, that's just, you can take that trade to the upside, and it was a pretty good trade. Here we had a really skinny one, so this one was suggesting a pretty big move incoming. You could see that we're actually leaving the bearish control zone. We're leaving the bearish control zone. We ended up flipping the midline to the upside, and then as we got embedded on the upside, price action was also getting embedded on the 2 standards deviation, and we could have just continued that long until we flipped this negative, until we broke under the EMA, and then that would have been exactly where we would have wanted to take some profit there, right? And then same thing over here. It was kind of fat, and then it suddenly got narrow. So that looked like a point of interest for us to potentially enter from this fat to this kind of narrow zone. We were embedded underneath it. We got embedded above the midline. We were pushing into the bullish control zone. We were coming from the midline here, pushing into the bullish control zone, and then the rest is history. You got an epic trade of 470%, just if you use my principles there. And of course, you probably could have taken some profit over here or over here on this hump or this hump or this hump or this hump if you were just trading when it starts to contract again. But that's up to you. I think as long as we're embedded in the bullish control zones, you just let it ride. And in this case, the RSI stuck its toe out. In this case, the Stoke stuck its toe out. Could have faked you out there, but as soon as you held that midline, you could have just gotten back into the trade, But at least you took your profit off the table in case it had broken underneath it. Like, you don't have to be stupid. Like, you can get back in, right? And then, of course, what happened, all this fat area over here contracted once again. Here you see the stochastic was on a downtrend, the RSI was on a downtrend. You were above it. You flipped the midline, you got embedded on the bottom side, and then you could take that trade to the downside. And that was when we got from that 60 to 30K in the summer, right, of 21. And then likewise, we see another squeeze right here where the RSI broke out of the bearish control zone, the stochastic broke out of the bearish control zone, and we flipped the midline of the Bollinger Bands to the upside. And look at this, we just got that really nice run back to 70K. And again, guys, you could just do it the other way around, and look, you got this whole run essentially to the downside. And then where did we end up flipping? To the positive side, of course, there's a little bit of a fake out here, but look, the RSI was just in the middle of the chart. Okay, it wasn't confirmed bullish right there. This is just in the middle of the chart. But what you can see here is that on this breakout, what's the difference between this breakout and this breakout right here? This one also got above the Bollinger Bands midline. This one came from below and got above the Bollinger Bands midline. What's the difference? The difference is here we did not get embedded in the bullish control zone on the RSI, and we actually ended up turning to the downside on the slow stochastic. By contrast, here we got embedded on the bullish control zone on the RSI, and we were having a positive bias on the slow stochastic, which then got embedded in that bullish control zone. And yes, we had that fake out during the banking crisis, right? But what happened, we had a contraction right there, and then you could have just done the exact same thing that I've been showing you how to do this entire episode. Guys, I hope you enjoyed this episode. I really do think that those examples should have given you an idea of how to manage Bollinger Bands, as well as the usefulness of not only the Bollinger Band midline in a Bollinger Bands strategy, but also the usefulness of the 20 simple moving average, because that's what the Bollinger Band midline is. And then, of course, those two standard deviations on the Bollinger Bands themselves, those outer lines, are kind of targets for you to keep in your mind that we can either continue to crawl up during runs, bull runs or bear runs, or limitations that we might get rejected from on just kind of small moves where it's just like up and then down, right? Where it's just like down and then up, right? You can just kind of take your profit there. And of course, when you're embedded, quote unquote embedded, because you're going to have flipped the Bollinger Band midline, and then you're also going to have flipped the the slow stochastic there. All right. All right, guys, that's your alpha for the day. Leave a like or a comment if you enjoyed this content. If you have any questions, feel free to leave them as well. That's your alpha for the day. Stay safe and happy trading.